Good afternoon, everyone. Welcome back to another exciting Full House Day luncheon meeting at the Peterson Institute for International Economics. It's great to see so many people here. Today we're here to talk about macroeconomic policy options for the world today, or in other words, can we do more stimulus? Should we do more stimulus? If we can do more stimulus, how should we do more stimulus? What would be the bad effects if we did more stimulus? All the things that inquiring macro minds want to know. We have a really all-star team here to talk about these issues, which of course are very topical heading into the IMF's World Bank spring meetings, as well as the G20 and G7 coming up. Of course, for many of us, myself included, at the Peterson Institute, issues of business cycle stabilization and macroeconomic stimulus have been a mainstay of our work, both in a global context, specifically for the US, but also for Europe in particular, and occasionally even on Japan. This discussion, of course, now has transferred over to China. But we are not blindly saying always more stimulus is better, or at least not all of us are. And so it's important to have the discussion and go through what really matters. We were fortunate yesterday, under the leadership of Paolo Moro, to have our semi-annual Global Economic Prospects meeting with Nick Lardy speaking on China and myself on the US. And while the two events are independent, we like to think of this as a very good 1-2 punch. Yesterday, sort of looking at the positive, what is the outlook and risks for the world economy? Today, looking at the normative, what should be the policy approach in response? That said, everyone is, of course, as always, responsible for their individual opinions. There is no institute view. We are just very grateful to give this forum. Starting off today will be my dear colleague, Joseph Gagnon, who is, of course, a senior fellow here at the Institute, previously had been visiting associate director to the Division of Monetary Affairs at the Federal Reserve Board from 2008 to 2009, where he was one of the lead people advising the chairman and the FOMC on how to do QE1. He has, prior to that, of course, had a long distinguished career in the Division of International Finance at the Federal Reserve and worked at the U.S. Treasury. Joe has, among all of us, been out there in front on looking empirically and creatively at issues of quantitative easing, and we're proud to release today his latest policy brief, Quantitative Easing, an Unappreciated Success, or an Underappreciated Success. And that will obviously underpin some of Joe's remarks today on monetary stimulus. Following Joe, we are delighted to have Professor Jay Shambaugh, who is currently a member of the Council of Economic Advisors, the de facto international economist there. Jay is a friend of long standing. He's on leave from George Washington University, where he's professor of economics and international affairs. He's long been affiliated with the NBER, and he held various senior positions at a staff level at the CEA between 2009 and 2011, including as chief economist. Jay will be taking up the fiscal side of the question, and not just for the U.S. Where is there fiscal room and what people might usefully do? And obviously the U.S. will be expressing opinions on that to its friends and neighbors in coming days. We have two very distinguished discussants to help us through this. First, we're going to have Patrick Honohan, who recently stepped down after service of more than 6 years as governor of the Central Bank of Ireland. Dr. Honohan, therefore, obviously was there for the entire cleanup and recovery of Ireland, and of course should take all credit for so doing. I say that because I'm proud to announce that Patrick will now be a non-resident senior fellow at the Peterson Institute, and we look forward to having his presence here recurrently as often as he feels fit, and are delighted to have him here today. He is, of course, previously not only a distinguished professor of international financial economics and development at Trinity College Dublin, he was a senior advisor in the World Bank working on foreign financial policy reform. So Patrick will be here to take up obviously both issues, but I think primarily on the monetary side. And we have someone of equal stature from the official sector to talk about the fiscal side, Dr. Carlo Cottarelli. Carlo is currently an executive director at the IMF. Of course, most of us know him as when he served as director of the Fiscal Affairs Department at the IMF from November 2008 to October 2013. We had him speak here at the Institute numerous times in that role. Far more importantly, he played a key role in issues of both European and global fiscal affairs and promoted a lot of very good research which continues to come out of the IMF's fiscal department. He had previously worked as a deputy director in both the European Department, Strategy, Policy, and Review, and has a background in the research department of the Bank of Italy. Without belaboring the point, Carlo has scars from trying to manage fiscal policy in Italy as well. So like Patrick, he brings a real-world policy perspective to our panel. So it's a terrific group, and as always, we will look forward to an on-the-record exchange of views and discussion with our high-level audience following their remarks. But first, let me turn to Joe Gagnon.
Well, thanks, Adam, and thanks to all of you for showing up today. I'm going to talk about what central banks can do. Before I get into the details of central bank ammunition, I'd like to make 2 points. One is that for the United States today, I don't see much need for stimulus, or possibly none right now. I mean, it seems like we're on a good path, close to objectives for employment and inflation, on path to probably achieve them. In the near future, employment's growing above potential, so it seems that this is not a live issue right now, but you never know. There could be a negative shock, and we always need to know what possible tools could be used. I think in the euro area and Japan especially, it seems like this indeed is a live issue, and I would argue that these regions need more stimulus than they're already getting. The other point to make is that the way monetary policy works is that it lowers rates of return. Conventional policy lowers rates of return on short-term assets and has spillovers to other assets, and unconventional policy lowers rates of return on other assets. And always policy lowers rates of return on basically all assets to different degrees, but that's how it works. It basically tilts the playing field towards borrowers away from savers, and this does have some distributional effects, but it's what the economy needs to get spending up to potential, to get the economy on track. And ultimately, central banks really don't determine what the rate of interest, the real rate of interest is. That's given by the market. That's sort of what the people's desire for saving investment is and how it interacts with productive opportunities. Central banks can only try to get us to that equilibrium faster. So I think a lot of criticism of low rates, of QE, of negative rates is really driven by this feeling on the part of savers that this is hurting them, and it indeed is. But it's not fair to blame central banks for this. There's nothing they can do about the underlying economy. And in fact, as Ben Bernanke has said, if you get back to full employment faster, you'll probably see a rise in interest rates sooner, and that will be better for savers in the long run. Okay, so but what are the tools available? Well, the first tool that's gotten a lot of attention lately is negative interest rates. And I would argue that these are working pretty much as expected, as normal policy does, and that concerns in the market are overdone. But I think it needs to be said that there's not a lot of scope for negative rates. When I was at the Fed a few years ago, and in the crisis we lowered rates effectively to zero, we thought that was the most we could do. The fundamental reason is cash. Why would you invest in anything or lend to anyone at a negative rate of interest when you can hold $100 bills in a safe, in a vault somewhere, and get a guaranteed return of zero for as long as you wanted? The idea that people would switch into cash in a big way lay behind the view that we couldn't have negative rates. Well, it turns out we can have somewhat negative rates as we're learning, but we don't know quite yet how much negative they can go. Clearly, -1 is possible. Is negative 2 possible? We don't know. We may learn going forward, but there's clearly a limit there, and it's probably not too much farther. So that's correct, and that's the concern about the limits to negative rates. But to the extent that we can have them, they do seem to be working pretty much as expected. They're passing through into money markets and bond yields and exchange rates, just the way normal policy does. They're even passing through to deposit rates for wholesale customers. There's a bit of issue about whether they can go to retail customers. There's some stuff that we'll still be learning, but the concern about bank profitability seems to be overstated. Bank profits in Europe and U.S. are doing pretty well. It's clear that central banks have tools to mitigate some of those concerns if they want to. But in the end, there's not that much more room. QE is what I'm going to spend most of my time on, so I'll come back to it. It seems like it is effective and has no loss of potency. A third policy that central banks have would be to try to raise expectations of inflation going forward if they were to raise either temporarily or permanently their goals for inflation and communicate that to the market. That would help to lower real rates of return, which would help to encourage spending. But I think that this policy on its own probably won't work. You'll need to back it up with some other policy that is large and credible and aimed at achieving that objective. But if you are going to be doing negative rates and you are going to be doing QE, and you want even to amplify the effect if you feel that's necessary, something like this could help. It could have some synergies. Finally, and I won't be able to talk about this too much, and it does impede on what Jay's going to say, perhaps, is the idea of helicopter money. Has gotten a lot of attention. Ben Bernanke wrote a post on this just this week. I think it's clearly a powerful option that would have a lot of room to run, but it would probably require legislation in some countries to give central banks some authority, some fiscal type authorities to basically mail out tax rebates or checks to people. There's a lot of issues around that. I would argue that it might be worth exploring, and certainly under certain limited circumstances we could do it, but that's really going afield from what central banks currently have the power to do, and I won't spend much time talking about it, but I do think it's something we might want to explore. So I'm going to focus the rest of my time on quantitative easing. There are three channels by which QE affects the economy. The first is that it tends to calm markets in a panic, pushing down spreads and yields. And people see the central bank is on the job and doing things that are helpful. The second is that often when central banks do QE, they're also trying to ease policy in every way they can think of, and they're trying to convince the markets that they're going to keep interest rates low for a long time, so-called forward guidance. Well, quantitative easing is a way of putting your money where your mouth is and making that forward guidance more credible. Indeed, it seems to have worked. And then the third channel is that you're buying riskier assets or longer-term assets in people's portfolios and giving them a safe short-term liquid asset. And so that will tend to lower the premiums they require on those assets, pushes those prices of those assets up, makes people feel wealthier. It also lowers the borrowing cost, financing cost for people who issue those assets, encourages spending. And this channel ultimately is the main long-run channel for QE. Okay, so you sometimes hear people say, well, QE worked in the crisis and the recession, but it's run its course and it's not potent anymore. Well, that's not strictly true, but there's a germ of truth to it, and you can understand how that got out there. The first two channels probably really aren't working anymore right now. We're not in a panic, and central banks, by and large, have convinced the markets, more than convinced the markets, that they're going to keep their policy rates low for a very long time. So doing more QE is really not going to buy you anything in the first two channels, and in that sense, it's less powerful than it was back in 2008-09. But the third channel is still there, and there's no evidence that that third channel is weakening. In fact, it seems to be quite robust. So you'll never be able to see this, I understand, but this table is in the little policy brief that you got at the front table when you got here, and I'm not going to go into it in detail, but the key point here is that dozens of studies have now been published looking at the effects of quantitative easing. And I got over 30 in this table, and there's a bunch more that really couldn't be quantified quite in this precise way in the table. But so 3 or 4 dozen studies, all of them find that QE lowers bond yields. I can't think of a field in economics, in empirical economics, where everybody looking at the topic got the same answer so quickly and so with such broad consensus. Now, there are differences in the size that people find. It's always the same effect, but different sizes. And to some extent, the larger magnitudes here are studies that really capture all 3 channels of quantitative easing, so they're big. The smaller studies are the ones that really zero in on the third effect, which is the one that's continuing. And I think it's fair to say you throw out some of the extremely low outliers and the high outliers, and you sort of focus on those, the core, the central tendency of those studies that focus on that third effect, the effect that's still there, still potent, still working, is that if you buy long-term bonds equivalent to 10% of GDP, you will lower the bond yield permanently by 50 basis points, or half a percentage point. It's not a huge effect, but it is macroeconomically important. It's roughly equivalent to a 100 basis point decline in your policy rate, and there's a lot of scope for doing a lot of that. Which leads to my final slide. How much scope is there for continuing to push on this margin if we need to? And this is from the briefing we put out last month called the Reality Check for the World Economy. It's available on our website. It's a table in the final chapter. What you find is for the major central banks on the left, the 4 major regions, advanced regions, central banks have blown up their balance sheets a lot. They've done a lot of QE as well as other things. So the size of central bank balance sheets there in the left column, about 25% of GDP for most and 75 for Japan, is about 3 or 4 times bigger than it was before the crisis. So you see the effect of QE on their balance sheets. And yet they haven't come close, except for Japan. They haven't bought more than 10% of market assets they could buy. There's plenty of room for them to buy more if they wanted to. I think Japan is the one that's gone the farthest, where they bought maybe 20%. So that's an issue. I think the real remaining, and the interesting point I'd like to leave you with is, should we go beyond just government bonds? Should we go beyond, we've gone into the longer, from medium-term government bonds into the longest-term government bonds. That seems to help. But I think Japan really raises the issue, I'd say, where we were struggling with at this point. 10-year bond yields in Japan are now negative, slightly, about 0. Probably there is a zero-bound issue, even for QE in long-term bonds. I mean, you have the option of holding 10,000 yen banknotes in a safe. How much more will QE in Japan lower the 10-year bond yield? It's not clear how much more. And it definitely raises the issue of whether Japan should be buying riskier private bonds and equity. They are buying some equity and they're buying some real estate, but tiny, tiny amounts. Should they buy a lot more? There's every reason to think that if central banks buy riskier assets, they'll have a more powerful effect dollar for dollar. It will raise some fiscal issues in terms of the potential for losses down the road, but it should have more macroeconomic stimulus, and there's plenty of scope for it. So this is the cutting edge, I think. Thank you.
Good afternoon. Great. So first I want to just thank Adam for asking me to do this. I'm a big fan of a lot of the work that comes out of Peterson, so it's a real pleasure to be here today to talk with you. I'm going to talk about fiscal space and fiscal stimulus, and I'm going to broadly agree with Joe that it's not clear the U.S. is the first place you'd be looking to have a focus on how much stimulus should be done right now. And so I'm going to try to take a picture of the world in some sense. Does the world need fiscal stimulus? And if so, in some sense, the question of where would that be feasible or where would it make sense? And I'm going to take it from a perspective that if you think of why and where do you want more fiscal stimulus, you tend to think about the idea that, look, if demand is too low in an economy, that's the first order question you're thinking about. And it's especially if monetary policy isn't set to immediately crowd out. So in particular, if monetary policy is at the zero lower bound, but just in general, if the monetary agents are trying to increase growth too, then maybe the fiscal would be more effective, especially if there is fiscal space such that doing more stimulus isn't going to terrify the markets and cause other types of problems or lead to long-term debt sustainability issues. But then also to think a little bit about the idea that there are generally, we think, positive fiscal spillovers, positive global spillovers from stimulus in a way that may or may not always show up on the monetary side, that it may have a slightly different aspect and one where collective action may make a little bit more sense even. And so I'm going to try to look quickly at how we think about whether these conditions are satisfied right now. And so if you just look at what various policymakers or former policymakers or institutions are saying right now, there actually does seem to be a fairly solid consensus that the world could use some more aggregate demand. And so whether it's reading statements from the G20, the most recent statement they put out where they said, we will use fiscal policy flexibility to strengthen growth. So it's a fairly stark statement that, yes, we need to do this collectively. Fiscal policy should be geared more towards growth and not necessarily towards shutting down growth. Whether it's people like former Chair Bernanke saying fiscal policy has a role to play, recent comments from Christine Lagarde talking about monetary policy would be much more effective right now if it were supported by fiscal policy. The recent WEO chapter that notes the way that structural policies are far more effective if they're in fact supported by fiscal policies early on. Or whether it's the OECD who's been calling for more fiscal stimulus and noting explicitly that many countries have space and could be doing it. I think in many countries around the world, and this shows up in particular in Christine Lagarde's statement, it's the idea that monetary policy is trying. And it's not a statement that monetary policy can't do anything, as Joe's pointing out, but that it certainly would be helped if the fiscal policy weren't acting in the opposite direction than what the monetary authorities are trying to do. So why do I think people have this view that we could use something more? So I'm not quite sure how well you can read this graph. So some of these graphs are deliberately stolen from the economic report of the president just as advertising, so you can go back and read all about them in the economic report of the president. But what this figure, all you should be able to see here is there's this black line that's getting lower and lower, and then all of these lines that keep shooting up and curving off but never show up. And those are progressive forecasts from the WEO. And I'm very much not trying to pick on the IMF because this was true for everybody. That everybody thought, well, growth is slowing, but it's going to rebound. And then it didn't. It slowed more. But it's going to rebound again. And not only did we keep thinking it would rebound, and it didn't, but we kept thinking it would rebound less. We were learning that it's not going to pick up quite as strongly. But even with that learning, we were still overly optimistic. And so I think in that sense, and I think I deliberately put in there forecast 3.x because it just came out today and it was lowered again today relative to January. It was lowered again, what the IMF is forecasting for growth this year. And so there is this sense that the world is growing slower than we think it should be growing, slower than we thought it could have grown a little while ago, and slower than we think it should be growing right now. And there are a number of reasons for that, and some of them make perfect sense, whether it's demographic shifts in a lot of countries where we just say, yes, growth is going to be slower than it used to be based on demographics and based on population growth. And it could also, and there's something going on with productivity that you may think has some demand-related elements to it, or you may think it doesn't, but it does appear that there's weak aggregate demand in a lot of countries, even if their labor markets have rebounded in some cases. And the reason I would argue that is, in one case, is just if you look at prices. And it's very hard to see the supply constraints out there, right? Even if you see unemployment rates coming down, it's very hard to see that the world is facing big supply constraints when we tend to see lots of parts of the world struggling with low inflation, not bumping up against higher inflation. So the first figure is showing you the red line is the commodity prices X energy. So just taking out the fact that something's going on with oil, we see, and this is the 12-month change, that commodity prices have been falling, and they tend to correlate quite strongly with industrial production growth around the world. And so as that blue line, the industrial production growth around the world has been getting closer and closer to zero, we tend to find commodity prices falling. And so in that sense, it's an argument that we are seeing weaker growth, and that's leading to falling prices. And in that sense, it's very hard to say that this is a supply-constrained growth problem that we're facing in the world as opposed to one where there's not enough demand. Similarly, the chart on the right is showing you the share of countries in the G20 that have very low inflation. So the dark bars are below 0, in fact, and the yellow bars are below 1, well, between 1 and 0. And short of 2009, these last 2 years have been the peak where we've seen this, where there are more countries in the G20 struggling with very, very low inflation, almost certainly much lower than their central banks would like to see. And so again, that strikes me as evidence that what we're facing in the low growth around the world is not strictly a supply problem. There are always supply problems, and we should always be concerned about structural policies that maximize growth potential. But that there's something else going on as well, that some sort of fiscal stimulus could play a role in helping. The other way you could look at this across countries is to look at the current account balance and say there are a lot of countries, major economies in the world, that are producing a lot more than they're demanding, right? That they have higher savings than they have investment, or differently, they have higher output than they have demand from domestic demand. And knowing that sometimes countries may have different optimal targets, you could take the IMF's word for what those optimal targets are, and they're still way above their optimal targets as well, suggesting that more demand coming from these countries would be warranted, not just for the world economy, but based on their own outcomes. One thing you would note, the U.S. is certainly on the opposite side of that, where it has a deficit. It's a much smaller current account deficit than it used to be, but it's still larger than the one that the IMF would suggest is appropriate. If we think about fiscal space, it's in some ways a harder question because it's not always clear what fiscal space means and what limits to borrowing countries face. Countries seem to be able to borrow until suddenly they can't, and that makes it a little bit harder sometimes to say what fiscal space is. You could look at the blue bars, which is their gross debt to GDP measures, and in some cases they look very high. On the other hand, in some of those countries that have very high gross debt figures that often get quoted, their net debt is much lower because they hold substantial financial assets, which makes it even less clear that they don't have stimulus, and that there are a number of countries who have operated at relatively high debt to GDP ratios for a long time, and many major countries that are far below those levels. The emerging countries in the G20 have much lower debt levels, although they may feel that they have less trust in the market and don't want to push those quite as far. We could look instead and say, what do the markets think about fiscal space? And I think there it's far less ambiguous, right? The markets are begging large governments to borrow. They are literally paying them to borrow in Japan's case and coming pretty close in a number of other countries' cases, even at longer terms. And so while inflation has come down and inflation expectations have come down from 1986 today, they have not come down that much. And the real yields on government debt are just far, far lower, suggesting that the markets think there is adequate space if countries would like to do stimulus. If I look, and then just lastly, very quickly, there are constraints to stimulus in some places that are more institutional. So in some countries within the EU, depending on where they sit within the euro, they are going to face constraints as to whether they bump up against a 3% target. And there are a bunch of countries in red over on the right there that literally would not be allowed to spend more if they wanted to. On the other hand, there's still a bunch who could if they wanted to. And so that comes up as the other issue. The broader struggle is that there is no one institution in Europe whose responsibility it is to maintain aggregate demand outside of the central bank. And so there is no one who is trying to play the fiscal agent for the entire European Union. Each country is in some sense playing their own role there. So if we took really quickly then at the US case, I would argue quickly there is fiscal space. Fiscal is actually a little bit supportive now than it has been in the recent past. And so I would not say by any stretch the U.S. is in a broad stimulative fiscal role, but it's not in a contractionary role the way it has been for the last few years. On the other hand, the economy is looking reasonably good on some lenses, not as good in other lenses. But monetary policy is normalizing the current accounts in deficit. It's just a less obvious case that you would start with the U.S. if you said the world needs more fiscal stimulus, that you would point here first. It instead suggests perhaps the world needs more aggregate demand, and the U.S. is already playing some role in that, and it would benefit from support from a number of other countries around the world. So the reason I would just very quickly say, why do I think the U.S. has space? Well, for starters, the deficit has returned to a more stable level to a level that stabilizes debt to GDP. Depends on your view of how you want to estimate it, but both the OMB projections of the current budget as well as CBO's estimate of the president's budget both have the deficit stabilizing in an area that would keep debt to GDP fairly stable, which is a big change from more recently. So there's clearly more room now than there used to be on that metric. And you see that on the left on the debt to GDP, where that has flattened out, projections going forward, at least for the next decade, before turning up some. But the figure on the right shows even if you don't take into account any of the changes in the budget that would try to keep that debt to GDP stable, the black line shows kind of the continuation of current policies. And I think what's important is that relative to what that line looked like 6 years prior, where that line used to go up quite a bit. And so there's been a massive amount of fiscal consolidation over the long term that has put the U.S. back in a position that there's no reason to think it doesn't have fiscal space if it wanted fiscal space. Of course, on top of that is the idea that there's no reason, even if you think you have limited fiscal space in a broad sense, that you could not pair stimulus today with longer-term debt reduction that left the debt-to-GDP ratio in the out years constant, even with stimulus. So even countries that fear they may have more limited space, there's always the option to proceed in that manner, which should leave you plenty of space. So this is the picture I was discussing, that the U.S. is less contractionary than it has been. The blue parts of that bar are state and local. The red is federal. As of last year, federal had finally quit contracting on putting contractionary power on the U.S. economy, and into 16, it should actually be mildly positive, with state and local having shifted to positive as well. There will actually be a mild positive impetus into the U.S. economy coming from fiscal going into 16, which is, again, why I think in some sense it's not the first place you would look for more stimulus, because it's already at least not contracting, and based on where the economy is probably not your first order place to go, setting aside the question of politically whether you could actually get to, there's a different question of is there political space for fiscal stimulus that as an economist I won't address. So just, I think we all know what the economy looks like. So just summing up, I think there is evidence the world is truly struggling with a lack of aggregate demand and could use more of it. And that monetary policy is trying to play a supportive role, as Joe said, in many places. And I'll leave aside whether it could do more for his talk and Patrick's comments, but to say that fiscal policy certainly looks like it could do more in many places, especially based on the idea that it appears there's more of a demand deficiency as well as whether there's a supply deficiency. I haven't tried to address the fact productivity growth is low in almost every country. There are many problems there. But that demand itself appears to be a barrier, not the only barrier, but a barrier to growth right now. And there's reason to think that there could be more done here, and that in this last point, that there is this potential collective action problems, that the countries that are doing a little better who may have more space may not want to use that space because they themselves don't see a need quite as strongly, and that back in the crisis, everybody got together and said, we will all do stimulus and we will not free ride on one another. And barring that kind of existential threat, there seems to be an inability to get back to that moment. The more recent statements coming out of the G20 have been more positive in that regard, and so I think we would be hopeful that they would continue on in that direction. So I'll stop there.
Thanks very much to Adam for inviting me, and it's my first time to speak at Peterson, so it's great to be here. I want to talk just about the European Union, in fact, really about the euro area in my remarks. And I suppose there are three words that would summarize what I want to talk about. Convexity, collective action. Jay just mentioned it. I'm supposed to be a discussant, but I just discovered he was going to say collective action, so that's good. And financial engineering. Yes, the euro area is still operating below potential, so there's need for something. Unemployment is falling, but not far enough. It was over 12, the worst of the crisis. Is now 10.4 is the latest number. 2008 was 7.25. So it may never get down to where the US is, but there's a long way to go. Balance of payment surplus is around 3% of GDP. Actually, it's in its seasonal way, it's zigzagging up and up and up for the last 2 or 3 years. So there's stuff that needs to be done. So the first word, convexity. Well, that's just a complicated term to I don't want to say that monetary policy is running out of road. That's not the way. That's not what's going on. But what's going on is it's the wrong mix. Convexity meaning that a mix is better than the extremes. And at the moment in the euro area, we have an extreme. We have an extreme between monetary and fiscal. And I'm not going to talk about structural, but we have an unprecedented reliance on expansionary monetary policy. And that's correct. Given what fiscal is doing or not doing, it's absolutely essential and correct for monetary policy to be as expansionary as it is. Now, why do I say it's unprecedented? Well, it's unprecedented because not only do you have QE, so lots of countries have had QE in the last post-crisis, but we have the combination of the negative interest rate and QE. So it's definitely unprecedented. Negative interest rate on bank deposits at the ECB, 40 basis points, minus 40 basis points. And the ECB is pumping those deposits into the system at the rate of 80 billion euros a month. So that adds the deposits. Unavoidably, somehow they end up as deposits at the central bank. Now, there is an irony in this because the impact of this expansionary monetary policy is highest. You have the lowest interest rates where it's least needed. It's the surplus countries that have the biggest excess deposits and the lowest interest rates. Greece doesn't have particularly low interest rates. So that is an irony, and it's an irony that will be also reflected in the fiscal situation. And it's an irony that's been there. It's sort of part of the structure of the way the system works. Hard to avoid it. The ECB was quite prudent and cautious in crossing this zero bound line. There were a lot of concerns that there might be Y2K type issues, and it moved slowly, probably far too slowly, some people will say, but it has thrown everything available in sequence, or it has been throwing everything available in sequence, even if their effectiveness diminishes. And Joe has suggested that effectiveness of QE does not diminish. Whether it diminishes or not, there's still plenty of room to go and dimensions to go in QE. But the ECB has been doing so as part of that signaling way of convincing the market that zero is not below but close to 2%. Below but close to 2% is in the medium term is the ECB's target for inflation rate. I think that means 1.9 something. But anyway, it doesn't mean zero, and it doesn't mean 1% on the core on core inflation. This policy package is working. There is a pass through to bank lending rates. ECB's estimates have just were published in the last few days. They reckon that there's a 40 to 60 basis point reduction in bank lending rates, 1.5% impact on GDP in this period, 2015-2018, and an impact on inflation, even though inflation is still around zero. There's also an unquestioned legitimacy about what the ECB is doing. It was set up as an independent entity to deliver price stability, defined as 2%. So it's got to deliver on that. Not only can it deliver on it, it's got to deliver on it. So nobody can say, oh, you shouldn't be trying to do that. And that's relevant in considering what other things the ECB should be doing. For example, what about the distributional effects of this and other policies that it could adopt? It seems to me that it's clear that the ECB can do anything that central banks would have within their mandate, adjusting interest rates, buying and selling assets to achieve that 2%. When it comes to helicopter money, as an aside, it's not quite so clear. I mean, no central banks ever went around handing out money before. That's not to say they couldn't do it, but they would need an additional mandate. And I think that's really something that should be thought about carefully. There is that interaction between the monetary and the fiscal here, despite the independence of the central bank. if, by the way, the ECB were to use its 80 billion to write checks to everybody in the euro area, it could be quite substantial. I think in Lithuania, which is the lowest income country, it would be about 25% of GDP. So that would be quite a big check to get. But very distributional, because everybody would get the same amount, I suppose. But it just tells you that there are a lot of things that can be done with when there is an interaction is proposed between monetary and fiscal policy. Very challenging area. Could more be done on the fiscal side? Jay has talked about this, and I think I'm risk using too much time. Fiscal space. There is some fiscal space in the euro area as a whole. Debt to GDP ratio of the area as a whole is 93, 94%. So there's not as much fiscal space as you might think. And again, the irony, the fiscal space is there in the countries that don't need it. And Jay has mentioned this for the world as a whole, but it's clearly there. And we've been here before. I mean, there's cultural or political features which persist for decades. Some parts of the euro area, long before it was the euro area, have seen more wage restraint, more export surplus, more high saving for decades. If you read Harold James's prehistory of the euro and the debates between European community countries over the years. The potential exists for collective action to use the fiscal space in the area as a whole to meet this lack of demand. But it requires a degree, some extent of financial engineering. And that requires trust and creditworthiness that doesn't exist at present. And let me take an example about Greece, which is not the example you think. You think that people don't trust Greece. Well, maybe that can be discussed. But the point I want to raise is the fact that the extend and pretend approach to the Greek debt, that creates a lack of trust about financial arrangements, about intergovernmental contracts, about financial engineering that could be put in place in Europe. If people think none of these contracts really, they have the potential not to mean what they say, then you can't use such contracts. I think financial engineering could be used to bridge some of these gaps between what is available to the Union and the euro area as a whole and the challenges that exist in particular countries. But for the moment, they're not being used. And let me give you, finally, an example where I think they could have been used in my own country. Okay, so we're very satisfied to have a reasonably rapid recovery from the crisis. But there were missed opportunities in the contracts that were made between the providers of funds and the Irish government borrowing. If instead of straightforward debt, there had been a GDP-linked repayment schedule proposed for the resources drawn by the Irish government, then I am quite convinced that instead of lying in the doldrums for 18 months after the program was signed, the recovery, the reasonably rapid recovery which we see now, could have been started 18 months earlier. And it would have been a win-win situation because the rates of return on the official loans, well, the IMF is one thing, but the official European loans are very low. And you can write lots of contracts that would have been acceptable to the Irish side, which would have ended up with a more rapid growth and therefore the capacity to pay a much higher rate of return. And since tail risks in the banking system still remained at the time the program was being negotiated at the end of 2010, again there, bank equity injections, insurance on bank tail risks, they could have been part of the financial arrangements, and again, they would have restored confidence, which was lacking for yet many, many months after the program was put in place. So that's water under the bridge, win-win situations that were not used, these kinds of mechanisms could be used today. But as Jay says, we don't have an institution that's charged with doing this.
Hi, thanks for inviting me here today. This morning, the World Economic Outlook was published, and it gives somewhat a mixed picture. The world growth rates have been once again revised down, as it happened in the last few years. So our expectations have been again disappointed. World growth, however, continues to be positive. Actually, a small acceleration is projected between 2015, growth rate was 3%, with respect to 2016, when it's supposed to go up to 3.1%. At the same time, public debt remains high, particularly in advanced countries, but it's also increasing in emerging economies. So the world growth is continuing at about 3 plus something percent. Public debt is very high. 15, 20 years ago, I think that very few economists would have considered this situation as requiring fiscal stimulus on a broad basis. The consensus 15, 20 years ago was that fiscal stimulus was highly asymmetrical, so it was easy to expand, but then it was much more difficult to tighten fiscal policy to avoid an accumulation of public debt, and therefore it had to be resisted. And this, of course, would have been regarded as particularly problematic because of the very high level of public debt. This worldview was, in a way, completely shattered by two developments, which encouraged, made us look at the use of discretionary fiscal expansion in a more favorable way. The first, as we know, was the global financial crisis and the evidence that monetary policy was not sufficient to support aggregate demand because in a financial crisis the transmission mechanism had broken down, and perhaps because of a number of forces, the equilibrium real and even nominal interest rates had turned negative. The second element was perhaps the surprising evidence that in spite of this surge in public debt ratios in the last few years, interest rates on public debt remain very, very low. So maybe we had overestimated the risk of having public debt to GDP ratio in excess of 100%. Yes, of course, there were a few fiscal crises in Greece, in Portugal, in Ireland, and a few near misses in Italy and Spain. But this was regarded more as a result of the incomplete architecture of the euro area rather than to high public debt per se. So what does this all imply for the current economic conjuncture? First of all, we all agree that all countries, as the World Economic Outlook argues, all countries should have fiscal tools, should apply fiscal tools that for the same level of deficit maximize, support more aggregate demand in the short run and are conducive to more medium-term growth over the medium run. For the same deficit, you just change the composition of fiscal tools. Now, this is a no-brainer. There cannot be any interesting debate about this. We all love free meals, so everybody, this is not an issue for me. It's not an interesting issue. The issue is the extent to which fiscal deficit should be increased or should be reduced less rapidly for the countries that are implementing fiscal tightening in order to support more economic activity in spite of the high level of public debt. And even if there should be either a broad-based fiscal expansion or even a coordinated fiscal expansion of the kind that we had in 2008. My answer is that no, there is no case for a broad-based fiscal expansion, certainly not for a coordinated fiscal expansion, although in some selected cases, particularly in Europe, fiscal policy could be used to support economic activity. I arrived to this conclusion because of two reasons. First, the world economy is not in the same dire straits in which it was in 2008 to 2009. World growth may be disappointed, may have disappointed us on several rounds, as we saw in the previous chart, but maybe our expectations were just too optimistic, were just unrealistic. I'm afraid that those expectations of growth going back to 4.5% were built on the hope that the world could go back to the golden period between 2000 and 2007, when indeed the world economy grew at a rate of about 4.5%. Those rates were the anomaly. Growth rates for the world economy of 4.5% were the anomaly. In the 70s, in the 80s, in the 90s, the average world growth rate was about 3%, was not 4.5%. The anomaly was 2008, 2007, when we experienced exceptionally high growth rates and also an exceptionally high accumulation of private debt, which contributed to the 2008 to 2009 global crisis. The second reason why I think there is no case for a broad-based fiscal expansion is that if we look at the situation, let's look at the situation in specific countries. The United States, as it was noted by my friend Olivier in a recent interview to an Italian newspaper, the United States is close to full employment. There is no obvious case for a major fiscal expansion in the US. China's growth rate is decelerating, but fully in line with expectation. We could not expect China to continue to grow at 10%. India is growing at a very fast rate. There are other emerging economies that are decelerating, but many, including the IMF, argues that they don't have much fiscal space, partly because, I'm talking about the commodity exporters, during the good times they did not save much. So we are left with Europe, but then the issue is not whether there should be a broad-based fiscal expansion. The issue is whether fiscal policy should be more supportive in Europe. Of course, there are a few other countries like Canada, perhaps, where they could have a faster, a more supportive fiscal policy. But if we look at the whole picture, Canada is not that big. So we're talking about Europe. And in Europe, the issues are well known. Germany should, in my view, have a more expansionary fiscal policy, together with a few other surplus countries like the Netherlands. Germany should have a more expansionary fiscal policy because, not least because it is not growing much. 1.5% is not what we should expect from the country that should be the locomotive of Europe. There is also probably a case for moderating the pace of fiscal adjustment in some countries with a relatively high debt, like Italy, and this is indeed what is already happening, using the flexibility margins allowed by the SGP. But altogether, we're talking about a relatively small group of countries compared to the size of the world economy. Of course, things would be a bit different in Europe if there were a central fiscal capacity, if there were a central budget, a federal budget at the European level, but unfortunately this is not the case. A couple of more things that I want to underscore before ending. As I argued, the world growth rate is not too low, except unless we compare it with 2000, 2007. What is strange and disappointing is not the low growth rate. It is the fact that we achieve growth rates of between 3 and 3.5% in spite of very expansionary, super expansionary monetary policy. And monetary policy in this expansionary comes with some associated risks. So the real question is whether, perhaps aiming at the same growth rate, we should not have a more rebalancing between monetary and fiscal policy. Perhaps, but we should not forget that also expansionary fiscal policy come with some risks when public debt is already so high. Last point, and this is the thing that worries me most. We talk about the use of support stimulus, of supporting policy to support aggregate demand. I agree that there is a lack of aggregate demand. Again, the main thing is inflation. I think we have not, however, done enough work to wonder why there is not enough aggregate demand in the world, particularly in advanced countries. I think what is wrong in advanced countries in the world economy has fundamentally to do with something that is difficult to fix with expansionary monetary and fiscal policy. And it is related instead to the huge changes in income distribution that we have seen within advanced economies over the last 30 years. I'm talking about the fact, for example, that in the United States, the middle class is disappearing. The middle class has less purchasing power. We can offset this and induce the middle class to spend more by keeping interest rates very low, but this leads to the accumulation of debt, household debt, that we have seen in the United States, in the UK, and in other countries. So in my view, the problems that we're facing now in terms of aggregate demand have a lot to do with the income distribution, the changes in income distribution over the last years. Unfortunately, those cannot be easily fixed by expansionary monetary and fiscal policy. Thank you very much.
Thank you very much, Carlo. Thank you to all our speakers. If I could ask them to come up, take seats on the table. We will go right to questions from the audience. I think our speakers very calmly and seemingly persuasively said a number of probably rather controversial things. So, as usual, we have a traveling mic up front in Jessica's hand. We have a standing mic at back. Please identify yourself to ask a question, and please identify yourself when you stand to do it. Yes, at the back, if you want to go right to the mic.
Hi, thank you very much. You guys tread where mere mortals fear to.
I'm sorry, your name?
My name is Jo Marie Griesgraber. I'm with New Rules for Global Finance, and I'm in awe of your brilliance, all. Now, there was quite a different approach to debts from our first speaker to a last. Either we have a debt problem or we don't. And that seemed to be, I would welcome addressing that. Also, the U.S. may be at full employment, but yet how do you reconcile that with the fact that it seems that the middle class is disappearing and nobody's gotten a raise in that, not nobody, in that bracket for a generation. So how can you address that crazy situation?
Okay, some U.S.-related questions. Maybe Jay could start.
Sure. Taking the second one first, I would agree with Carlo that issues in inequality and distribution aren't purely a macroeconomic policy question. There are lots of much more fundamental structural issues there. I mean, I will say that I do actually think that proper demand management macro policy can have an important role to play in inequality areas, just in the sense that lots of people being unemployed is a pretty bad outcome for many people. And so avoiding that with proper demand management actually I think is an important part. But the question of have enough people gotten a raise and things like that I think has a lot more to do with a broad set of structural policies that aren't really in some sense in play in the question of should we do stimulus or not do stimulus. I think on the question of do we have a debt problem, I think there's probably more agreement between us than we maybe both staked out, in that I think there are certainly some, I would agree there are some countries where, you know, as I said, there are some countries that don't have a lot of space and therefore they would struggle, and unfortunately it's in many cases the countries that have the most clear need for stimulus. I guess I would argue that there is more space than older measures would suggest, and that may be where there's some disagreement, just in the sense that, you know, really low long-term interest rates, which are fundamentally lower than we used to think they would be, suggests that the optimal level of debt is higher than you used to guess. Just on that reason alone, I would argue that there's an argument that previous measures of how much space we have are maybe things that need to be updated, that low interest rate becomes a really important part, and that getting nominal GDP growth up, if what we care about is debt to GDP, right, nominal GDP growth is just as important as the debt part of that ratio, and that Japan having zero nominal GDP growth for 20 years is why they have such a high debt level, not just because they spent money. And so that when there are countries that are fundamentally stuck in a rut, and getting them back to a faster pace of GDP, and in particular of nominal GDP growth, is an important part, not just managing the debt level. And then I guess very quickly, just lastly, I think there are cases where you need to do certain things, whether it's infrastructure, spending on education and things like that, that you're going to need to do at some point. And if you think you have low demand right now, these are things that you can do now instead of 5 years from now. You're going to do them at some point. And that doesn't fundamentally change the profile of long-term debt, which, again, doesn't say there aren't reasons to be worried about debt, but suggests there may be more fiscal space than sometimes there appears.
Does anyone have a differing point of view they care to offer? Yeah, Carlo.
But somewhat different. On the issue of, I didn't mean to argue that fiscal stimulus in this situation or monetary stimulus in this situation would not help with aggregate demand. It would, but it would by creating more debt, more private debt or more public debt. And this does not fundamentally address, and this is due to the fact that there is this issue of income distribution. It's not poverty, it's the middle class that does not have enough purchasing power. On the issue of public debt, whether there is the debt problem, high public debt can be problematic in two respects. One is that it can cause a fiscal crisis. The other one is that and this is the very reason why economists in the 18th century started worrying about high public debt. It can lower the growth rate of the economy, the potential growth rate of the economy. Crowding out, high taxes, there is not enough money to invest. The first issue, clearly, I don't think it's a major issue at the moment, except in a few countries, including, however, because of their expansionary monetary policies. So things may change if at one point monetary policy will start being tightened. The second issue is an issue that, in my view, persists even now, is a slow-moving process, but I think we should worry about also that kind of impact.
Do you want to add something, Joe?
Yeah, just very briefly. I think it seems to me low interest rates are here for as far as we can see. I mean, you can never say something is absolutely permanent, but as far as any signal we have, they're here for a long time. That does change our thinking. I agree with Jay totally. And I would just add, in that context, central banks are not in charge of it. That isn't caused by central bank behavior. Central banks are responding to that. I think the only way to talk about whether monetary policy is too loose or too tight or has been loose is to look at nominal GDP growth. If that's really high, then monetary policy has been too loose. I would argue the opposite is true.
But before we go to another question, though, can I just push you guys on this for a second? Starting from Joe's premise, right, that this is what the real economy does, it isn't what central banks do. If the low interest rates in part reflect very negative expectations about the future, reflect deflationary expectations, possibly getting entrenched in places like Japan, if the low interest rates reflect bad productivity growth prospects going forward, does that really give you more fiscal room? I mean, because then you're in an environment where real growth is going to be slower going forward, and maybe you cannot expect to sustain nominal growth. I mean, I think I personally agree with you guys, but I think it would be good if you spelled out why it couldn't be that the low ongoing interest rates are actually a sign that things are more constrained rather than less constrained, or vice versa. Patrick, you seem to want to say.
I don't think we should.
Could you turn on the mic, please?
I don't think we should just assume that the long-term interest rates are there given from the outside world. I think these exceptional monetary policies have lowered the term structure and have and have the potential to lower risk premia as well. And I think that's driving something. And I think one of the things that it's driving is making existing debt more affordable. Not just promoting the accumulation of additional debt, but in an over-indebted economy, it's making that existing debt more affordable and less worrisome. And if the inflation rate got back up to where it should be, that would also help, because inflation for the last number of years and continuing is lower than people expected, and the debt ratios are higher as a result. So I think that's a huge part of this which can't be neglected.
Okay. Jay?
Sure. I say, I think broadly, I think if you honestly think that you have permanently lowered nominal GDP growth expectations, then yes, then as you do your long-term debt sustainability, the lower interest rate isn't changing anything. And I think it's a question of whether you think there is some fundamental reason. I mean, certainly there are some things, and this is where I would agree, especially about the lower growth, that there's no reason to expect to grow 4.5%, right? I mean, there's certainly things that look, but in that figure, it wasn't a range where we thought it was 5 and we're getting 3. It's like we're not even getting 3.5, and that kind of thing of just saying, is there some range that we should be growing a little faster, and in particular on the nominal GDP growth? And if that's the case, then I think that suggests if you think you're off a track and you need to get back to it, that's very different than if you've permanently shifted to a different and worse track.
Great. Thank you very much for clarifying. Here in front.
Fred Bergston at the Institute. To get this more specific, I'd like to ask each of the panelists to nominate 2 countries, and you can't repeat the previous
Oh, yes,
speaker.
they can. No. We want them to repeat, Fred.
Let's say this. If they repeat, then they have to name 2 more. Because I want to get a list of potential specific countries where you believe fiscal stimulus is called for. Now, Carlo very specifically said Germany and Netherlands, so repeat those, but each of you give us 2 more if you think there are 2 more that we could add to a list to be specific.
I don't want to fight Fred's question, but I think if it turned out 4 people all happened to say that a country beginning with GE had room to do something, that's just as useful as saying Abu Dhabi has room. But anyway, let's start with Patrick.
Can I give a twist to the answer? Of course I agree with Germany in that essence, but I think it should be done in such a way that that fiscal expansion has the impact where it's needed in the rest of the European Union. And that's where the financial engineering comes in. If you don't have a single fiscal, you don't. It may be that, yes, Germany should have more autobahns, but maybe there are also things that it could invest in through a public sector mechanism in the rest of Europe. And that's part of this so-called Juncker plan. But the Juncker plan involves new money of 0.1% of GDP. It's just not enough, and it's not fast enough.
We'll let Carlo go last so he can think of an obscure country to name. Jay.
So I'll start with Germany and the Netherlands, just as a basic. I mean, I do think the case for Germany spending more is almost unambiguous unless you have a different economic model of the world. And I would agree that if it could be done in a way that tried to push the spillover across the euro area, it would be even more appropriate. I think you can name a lot of countries in some sense. To me, it's countries that have a current account surplus and monetary policy pegged at 0 are the ones where it suggests most strongly that and are growing under trend. And so I would say Japan actually has been suggesting that they would like to do to inch forward a little bit, and there's no reason they couldn't. They would obviously have to be more careful in how they structure things based on present debt levels and things like that, but there's no reason one can't set out plans that encourage growth now to try to get the nominal GDP going and structure it in a sense that doesn't lift the long-term debt levels. And I think Canada has suggested that they see 0 interest rates and a lot of infrastructure needs as a pretty good reason to spend. And I think there's a fairly compelling case for that as well, especially given that they've taken a lot of losses in the economy based on slowdown in commodity markets.
Joe?
Well, I'll just join the court. I think euro area, the Juncker plan needs to be 20 or 30 times bigger. I mean, it's just ridiculously small. It's kind of stupid. But it would be great if it was of a decent size. And Germany investing in the other countries is exactly what you want. And then Canada, Australia, because commodity prices have fallen. Up till now, they haven't needed it, but now they have fiscal space. And I think Japan needs something, monetary and fiscal. Exactly what, I don't know.
Before I turn to Carla, I'll just say Olivier Blanchard and I have both been on the record saying, well, Japan needs something, but it may be much more about the nominal side than about the fiscal side at this point and pushing wages and things. Because even I'm worried about Japanese debt at this point. But Carlo, you get the last word on Fred's question.
Fred's question is a very good one because when we discuss within the fund, and I hope I'm not revealing any state secret here, at the board, when we discuss these things and we ask to have the list of the countries that are supposed to have fiscal space, we have not received the list. We've been asking for it, but it's still under, I don't know why, but they're still working on the list. Now, if you ask me, I would add to Germany and the Netherlands, Canada, for example. But again, we're not talking about huge things. I don't want to make major changes in the world economy. And public debt is very high in many countries that would need more demand support, like Italy, but just cannot afford it.
Can I just quickly ask a follow-up since I don't see a lineup of questions? Patrick mentioned the idea of convexity, which intuitively is about don't lean solely on monetary. Maybe you want a better fiscal monetary mix, which a lot of people feel. I mean, you were all discussing fiscal room in just sort of fiscal terms. Is there an argument for some countries to change the mix irrespective of these things, or is that just a secondary issue? But also, and maybe Fred wanted this, I don't know, but none of you mentioned China. And I'm actually quite surprised that none of you mentioned China, and I'd be interested in why you didn't mention China as having fiscal space and interest at this point. And Korea. Okay, so let's go down the line on those. Joe.
Yeah, I'm not an expert in how much China needs stimulus right now. I mean, it's not obvious to me that it needs it, but if it did need it, it has plenty of fiscal space, absolutely. And I do think Korea has a bit of a need as well as fiscal space, yes.
Okay.
So the answer as to why I didn't was I was told to name 2, and I'd already named 4. So it was the 5th name on my list. And in all seriousness, I here again I would agree with Carlo that I don't think they should stimulate aiming at 10%. But the notion that the transition to a different economy is a bumpy path, and they will inevitably hit bumps. The fact that I think establishing that the appropriate policy response to those bumps is consumer-oriented fiscal policy and not exchange rate devaluation is a really important precedent that the Chinese have expressed, and I think it's a precedent they need to make clear they're going to act on, because I think if they find themselves exactly on the path that they want to be on and they think they should be on, then maybe they don't need a surge in fiscal stimulus. They've already done some things recently, so that's, I guess, one other reason I didn't name them is they've done a little bit more recently. But if there were signals that they needed something, and I would say the same about the U.S., that that's one reason I said we have space, I think, if we needed to use it. If things suddenly do look a lot worse, there's no reason the U.S. could not respond with fiscal.
Better be brief because 2 other people waiting to talk.
Just on what Jay just said, in China, there's evidence in work I've done, the IMF have done separately, that fiscal policy aimed at social safety net, public health spending and education, has a vastly bigger effect on consumption in the current account than fiscal policy generally, and it's really worth pursuing that.
Okay, that was a worthwhile interjection. Thank you, Carlo.
That's exactly what I was going to say. Depends on what you mean by expansion in fiscal policy. The country is growing by this 6.5%, between 6 and 6.5%. I come from Italy, so for me, anything that is above 1% is a super high growth rate. So 6.5% seems to be, 6.3% seems to be a very high growth rate. I don't see per se the need to have taking major risk of any sort to boost it to 7, 8, or 9%. This said, however, if there is something that should be done is through social safety net, because it will affect private consumption. And it will not immediately involve a large accumulation of debt. We don't know enough about the state of public finances in China. Official debt is low, but if we include quasi-fiscal debt, we get to levels of 70%, 80%, which is not trivial, certainly for a country like China.
Patrick.
Yeah, no, I mean, that seems to me to be the question of how much fiscal capacity there is in China, as well as the needs. There are identified fiscal needs in China in the adjustment. They will have to spend a lot of money. Can I add one country?
Please.
In a nicely controversial way, I hope, a country that does not have any fiscal space but needs a fiscal stimulus, and that's Greece.
Needs a fiscal transfer. I'm afraid we're at the end of our time. Just on the China point, I would refer you to Nick Lardy's presentation yesterday in this hall, where he discussed China's transition on that path and where the fiscal policy might go and should go in that context. But today, I think we had a terrific, multifaceted, multi-country analytical look at the issue of stimulus. I'm grateful to Joe in particular for helping to put all this together, but also, of course, to Jay, to Carlo, and welcome and thank you to Patrick. Thank you all very much.